Hi, John Stoddard here. I wanted to share something with you today. How to raise money and acquire a company using other people's money. It's something I discovered in the last 10 years working on a couple acquisitions. So I'm not referring to a bank. I've been through that SBA process and the investment bank process where they charge you $25K just to start the paperwork. You know, the bank is going to determine your credit worthiness, your asset ratio, your debt coverage. Really, they're going to conduct a financial proctology on you. They do that because if anything goes south, they need to limit their exposure, and they do that by having a claim on your collateral. We're talking about your house, your assets, etc., or your other businesses. I'm referring to a wealthy, private, accredited investor. So there's kind of two there. If you can find a wealthy, passive, accredited investor to put up $20 million and take a minority interest, you know, someone that puts $5 million here or there because they inherited or they're retired, they are friends and family, or they have so much money they're doling it out. Congrats, man, that's great. I don't know any of those people. I'm referring to accredited investors that I know that are making investments. They are going to be active. They're going to play an active role in the investment. They are not going to be a minority player. They're not going to give you $20 million and take a 10% roll. They're just not going to give you $20 million to put in your bank with absolutely no say and no recourse. Look, it's just not going to happen. But I found a way to make an acquisition happen that reverses the risk to the accredited investor. I discovered this offer when I worked on an acquisition to purchase a company with 80% margins. And I found this wealthy investor, a guy was worth $185 million. I offered him 50% of the business. Take a look at this profile. He was a younger investor, I'm talking about in the 50s, hard charger, ambitious, a money-making guy, and a numbers guy. He wanted to turn his $185 million into $250 million, and he was actively looking for investments. I pitched the offer. He balked at my 50% offer and countered with, yes, I'll give you 50%, and no, I'll give you 50% of the business in 3 years with earnbacks hitting specific metrics. You start with 20% for bringing a great deal, managing the growth. I'll be the chairman advisor, sit on the board with the majority of the seats since I put up the money, and you can earn those back too. You hit all those metrics outlined in your plan, you will own 50% in 3 years. We'll find a buyer and we will both make tons of money. So, frankly, it was actually the best deal on the table. I actually presented two offers to the seller. One was debt from a bank. It was approved, ready to go. And number two, the wealthy accredited investor who already put money in the bank to make the acquisition, plus a lot of cushion for marketing. The seller chose cash, of course. So let me just kind of wrap up what this might look to you. Based upon the metrics and the plan I had, I started on day one with 20%. If I hit the metrics, year one, I get 10%. Year two, I'd get 10%. Year three, I'd get 10%. I'd end up with 50% over 3 years. The investor would start with 80%, go down to 70, 60, and 50%. But the asset value of the business after year three would be, 100 times larger than it was in day one. And we'd sell it and both make a ton of money. Look, I hope that helps. If you need any more help, reach out to me at milliondollarpitchdeck.com or Pitch Deck Secrets. Thanks, this is John.